What is the Fed funds rate? It's the interest rate that banks charge each other for very short-term, usually overnight loans. The Fed sets a target range for this rate. For example, 5.25%, 5.5%. When the Fed lowers it, borrowing becomes cheaper across the entire economy. How it affects you. When the Fed cuts that rate, it indirectly affects credit card rates. They tend to drop a bit. Car loans and personal loans, they get cheaper. Mortgage rates often fall, though not always immediately. Savings accounts, CDs, pay less interest. How it affects stocks. Lower interest rates encourage investment and spending. Companies can borrow more cheaply to expand. Investors move money out of savings and bonds and into stocks seeking better returns. So the stock market often rises when the Fed lowers rates, not because the stock's interest rate changed, but because money becomes cheaper and more plentiful. 1. Fed lowers rates, banks borrow cheaper. 2. Banks lend more cheaply, consumers and businesses spend more. 3. More spending, higher earnings and stock prices. 4. Too much spending, inflation risk. Fed might raise rates again. Subscribe for more.